Hey everybody, Signet here with the Bullish Bears, and this is a remake video. In the last video, OBS Studio was picking up a stream from another location on my computer. I run two computers. There was a stream, I wasn't hearing it, but OBS picked it up, and the audio was just all out of whack. So let's start over. This is a day trade that I put on today in the SPX, and out of the money, slightly at the money, vertical spread. This trade was $25 wide, and I collected $13.40 in credit. Now, the first thing that I want to point out, and I always point out, is that I don't live on the East Coast, so my time frame is different than the markets by 1 hour. If the trade says that it happened at 9:16, it was really at 10:16 in the morning. All right, so I filled this trade at 10:16 on the idea that we would break through the downside of the 5-minute expected move, and from that, I would get some of this credit. All right, so let's review where the price action was at when I took this trade. At 10:16 this morning, we were still hovering inside of that 5-minute expected move, or that 5-minute open range. And here is 10:16 right there. All right, so this is where I got filled in my trade. And not long after I got in, the market dumped and broke below the 5-minute open range, and my trade started to really see some profit. Why did I go ahead and pull the trigger here, even though we weren't at the lows and we weren't at the highs? Well, we want to go and bring in some market internals. So here is cumulative tick, and at 10:16 in the morning, you can see how we're all clustered up still. And then we want to look at regular tick. And at 10:16 this morning, we were just coming out from below the minus zone. We have volume in the NASDAQ. This is cumulative volume, just accumulating on the day. And then we had the S&P volume, also accumulating on the day, and it seemed a little light to me. But what I really want to point out is look at where the advancing versus the declining issues were at 10:16. We were just pegging out in the S&P, and in the NASDAQ at 10:16 we rolled over right there and just really started to dump. Right, so we were pegging out here as well when I put on the trade. We hadn't dumped yet. I got in right before that dump. All right, so we had the market internals telling us that we were just pegged out, max. If this was maximum bullishness, how come we weren't seeing that in the candles, right? And that's kind of what I was banking on when I did this trade. So I got in it, we rolled over and just dumped to the downside. Now I'm going to turn on a drawing here that kind of helps visualize this a little bit. If you have a mouse with a wheel on it, click the wheel and you get this little menu that pops up. We're going to look at the regression line from the start of the day, the very first candle, and just drag the mouse across to where I got in. Notice the angle and the slope of that. Now once you've already got that drawn, focus on the swing high, swing low, swing high, swing low, swing high, swing low. Each one of those swing highs were lower and lower and lower. And same with the swing lows. The idea would have been that we get lower and lower. We actually didn't have one there at that point, but we did get one a little later. Right? So it was trending to the downside, and our technicals were showing max bullishness. So we had some divergence there. Now, if you're kind of new to vertical spreads, the way that their pricing structure works is if you put on a trade that's $10 wide, then the entire trade has $10 in it. If you collect $3 in credit, you're risking 7. 7 and 3 make 10. If you collect $7, then you're risking 3. 7 and 3 make 10. Right? My trade that I put on was $25 wide. That's how big the trade was. So the entire trade altogether, profit and loss, has to equal $25. Let's go back and look at what I got the trade for. I opened the trade with $13.40 in credit. Anything beyond that to still get the $25 was risk. We have risk and reward. We put the two together, and that gives us the width of the spread. Now, after I had the trade and we broke to the downside, I actually rolled that position for a no-lose trade at that point. Let's look at the numbers and kind of game this out a little bit. I had a $25 wide trade for $13.40. Okay? And when I rolled it, I paid a debit of $7.40. We can see that because it's in red and the $13.40 is in green. Green shows that I collected credit and red shows that I paid a debit. But what I also want to point out is I made the trade much smaller. Now I was only holding a trade using the 40-50, 40-45, and we got to ask, well, what's the new value of the trade? If it was $13.40, what was it now? Well, after we subtract those two numbers, we'll see that it was $6. So I was holding $6 in credit in a trade that was only $5 wide. That gives me a no-lose guaranteed trade of at least a minimum value of $1, and that's $100. So I could have held this trade for the end of the day, and no matter what, my bare minimum profit would be $100, and there was no way that I could lose. But we continued to fall, and then I ended up closing the trade down for $395 profit because I bought to close for $205. Remember, I was holding $6 in credit. If I buy it back for $205, then I keep $395 as my profit. Now, this is the kind of thing that we want to focus on a day-to-day basis because we have zero-day trades now every single day of the week. Monday through Friday, we have zero-day trades. So we want to know that we have the capacity and the potential every day to put on trades. My original idea here was that we could really break to the downside. And we started to, but then we found support and we rallied back up again. My fear was in this rally back up that we could get really bullish, and I needed to make sure that that couldn't happen. So I originally rolled the trade since we started to stall out. And then I closed the trade because I wanted to be free and clear if I wanted an afternoon trade. Right? So I went ahead and closed that one down. I took my $400, and now we're looking for an afternoon opportunity just as good as the first opportunity. What I was really hoping for is that we would just continue to fall and fall and fall. Right? That would have been great because then we could have rolled that trade lower and made more money. If the S&P had fell all the way down to the previous day's low, and I was in a trade from way up here, we could have rolled it and got more credit, and then we could have rolled it again and got more credit. But that's not what worked out. And we adapted the trade to go ahead and lock in that no-lose guaranteed profit. Now, this is the kind of thing that we've been doing quite often, really, since we're not really putting on the same kind of swing trades that we used to put on. In the current market, I'm not really comfortable with the idea of putting on 30 to 45 day swings other than bearish trades. And when you're down, 7 weeks in a row, it's kind of hard to want to go short at that point, right? And that's what we've seen in the S&P. 7 weeks of just downside price action. It's not really the time to go short when we're already at the lows. And yet, who wants to go long in a market like this? So that leaves us kind of focusing on day-to-day trades and looking for a new opportunity to put on short trades. Now, don't get me wrong, we're still putting on trades, even in swings. They're just not very many because we have to wait for the market to rally back up again before we can go short again. If this kind of trade interests you and maybe you want to learn more about it, my name is Signet. Join the Bullish Bears. Come over and get into the Discord and reach out and give me a holler. Right? I love talking options. I love helping people understand them, trade them, find ideas on a better way to do it, fix trades that you're already in that maybe aren't working out the way you want. That is what we love to do. So if this interests you, come on over, give me a shout, and I'll see you guys in the Discord.